Here in South Africa, fleet management group Eqstra swung to a full-year profit of 78 cents per share. This from a loss of 22 cents per share in the same period a year ago. We now unpack those numbers with the company's CEO, Walter Hill. Thanks so much, Walter, for joining us this afternoon. Well, I've been reading through your numbers and lots of talk of resilience of the underlying business model, where a challenging year, has persisted, has come to the benefit of Eqstra. We've seen headline earnings per share improving to 77.9 cents. What do you attribute your resilience to?
I think it's the annuity model of the business. Most of our contracts are of a long-term nature with good corporate South African companies, and they have withstood the different economic climate stresses that we've been through.
Of course, a lot of reliance on that mining component and the mining sector specifically, if you're putting it in contrast to construction. So run us through the two stories and how those sectors have contributed to the earnings we're seeing in front of us today.
I think our construction mining equipment distributorship business was heavily hit by the economic downturn. We have managed to turn that business around and made a 40 million PBT profit from a 272 million PBT loss in the previous year. That is mainly attributable to rationalization of that business. We did have a revenue increase of that business from 1.1 billion to 1.3 billion as a result of good mining sales. But the biggest improvement has been the rationalization of that business, getting rid of stock and reducing the interest bill in our construction mining equipment distributorship business. The construction sector is still very much on a downturn. It's not a lot of activity there, so the big benefit has come from mining equipment sales.
There are still challenges that persist in the mining sector, though. I mean, in spite of all the opportunity that it's brought to the fore, the challenges came through in the fact that it has resulted in operating profit down, maintenance costs attributed to that, being attributed for that kind of decline that we've seen there, lower asset utilization as well, and then new contract startup costs as well. So run us through some of those challenges and how it's come to bear.
I think our contract mining business, MCC, is not performing at the level that we would like to. We would like to see higher operating margins come out of that business. We did have illegal industrial action at one of our operations with Platinum. That has been resolved, and we'll see the benefit of that next year. Unfortunately, we did have to take a 50 million impairment on assets that were damaged through illegal industrial unrest in that business. That is a once-off impairment charge. And then also the Benga project, that's the Rio Tinto project in Mozambique, that is starting to ramp up. That is quite a significant investment. We will invest in the region of 900 million rands worth of assets in Mozambique. We're not seeing the benefit yet of that revenue coming through, and that will start coming through in the next quarters, which will significantly improve the business performance for that division. Also,
where you touched on that impairment charge, to leasing assets, so one would assume that your insurance claims would ultimately filter through and offset some of those costs that you've had to incur this time around.
Quite correct. We've taken a very conservative approach and made a worst-case impairment. Salvaging and insurance costs may reduce and reverse that impairment.
Let's take a look at another division, passenger and commercial vehicle sales. The annuity contracts you've seen there supportive. We've also seen growth in the non-capital based value-added services. So run us through some of the strides you're making there, because this is very important, where we've still got the health of the South African consumer very much a concerning point at this stage, where growth isn't filtering through as fast as many had initially anticipated it would.
Yes, I think our passenger and commercial business is very much focused on the corporate market. We did hold back through the crisis. We did hold back on growth a bit, but we have focused on adding value-added products of an annuity nature to our existing asset base. The value-added services of our business are very important. 50% of our revenue comes from value-added services on the existing asset base that we lease to customers. So it's a very important component. and we've been developing that over the past year.
While you continue with progress on that front and continue to develop that arm of the business, I mean, at the same time, just looking at the current economic environment, one would assume that many want to lease and rent equipment now because banks are containing and restricting liquidity in the market. So to what extent is that working in your favor?
I think it is. We get a lot of additional requests to lease and rent equipment. We do, however, have a very strict credit approval process because ultimately the health of our accounts receivable is critical to our balance sheet and to the quality of our business. So we are very cautious in terms of taking on additional customers, and we do look very much intrinsically into the health of their balance sheets before we take them on. In terms of the economic activity in South Africa, our industrial equipment division is showing very positive signs in that we've had a 40% year-on-year growth in forklift sales. That is normally a lead indicator for economic activity in South Africa, so we're excited to watch the progress in that regard because that will ultimately affect the passenger and commercial division and its economic growth as well.
You touch on that industrial equipment division and its performance here in South Africa, but it also has quite an exposure to the UK market and Ireland as well. What kind of business are you seeing generated on that front?
We're very excited about our operations in the UK. We have just been given the distributorship for 100% of the UK and the Ireland territory, where previously we only had 25% of the market. Our profitability out of the UK has been the best since acquisition of the business in the UK. And we currently have 3% market share. Signs are very positive to ultimately achieve 10% market share in the UK, which will make it a very substantial business. The UK, although the market is very depressed, we have seen increased forklift sales and industrial equipment sales, and there's been a 20% year-on-year growth. It has been from a very low base, but there are positive signs on the industrial equipment. And again, I say industrial equipment sales are lead indicators because they track what's been moved in the form of raw materials and finished goods. So it's a very good sign and an indicator for us.
Well, some positivity coming through there, Walter. Let's leave it on that note. Walter Hill is CEO of Eqstra.